it's Don Kaufman, and you are watching the TheoTrade Weekend Update for October 23rd, 2020. Let's get right down to business. This is going to be a little bit of a different weekend update because we're going to discuss a little bit about, hedging. Because lately, I've kind of heard, listen, tons of traders have substantial size hedges on coming into this election. Does that mean that they believe there's going to be wild risk in the marketplace? Possibly. But the question that kind of looms, okay, if that kind of professional world, like if everybody is hedged, then where's the risk? And that's what we're going to dig into here. Again, on this weekend's update. Hopefully you'll find it kind of insightful. Let's kind of recap a couple of aspects of this past week of trade, and then, we'll get into it. I got to tell you, this last week, where did we end up on the week? Well, net over the last 2 weeks, we have been largely and massively unchanged. What I'm trying to point out here on the screen is, again, we did see some price action in this last week of trade, right? We sold off here, tried to rally, faded into the close, tried to rally, faded into the close, came all the way down to the lower edge of the expected move, and again, ended net mildly lower in the week. And that's according, of course, to the SPX. Take a quick glance over at the QQQ, and I think it's important right now to kind of, separate, if you will, the Nasdaq from the S&Ps from the Russell. So the Nasdaq also finished ever so slightly lower. Then, of course, we'll take a look at the Russell. The Russell actually finished the week slightly higher. But net, look at the Russell. All right, you've got, again, 2 weeks that we have been just, for the most part, again, unchanged inside of the Nasdaq. Not dissimilar at all. Total movement here is negligible on a week-to-week basis. So obviously the markets are kind of marking a little bit of time coming into the election, maybe waiting on stimulus here. Although I'll tell you, the markets do not seem to be paying much attention to any of the economic data coming out. There was, of course, some data like PMI numbers this morning. That didn't impact the S&Ps. I didn't even notice it at all inside of the S&Ps this morning. Whereas, again, some of the economic data that came out, the prior day, the jobless claims, no impact whatsoever to the S&Ps. We're just not listening to anything. And that's why we're going to talk a little bit about, a lot of people, again, have discussed how hedged they are right now. Again, we're going to look into that. Before I do, again, I want to cover one other aspect that I think is important. And this one really kind of caught my attention this week. You have bonds that had a fairly substantial sell-off, and this one kind of caught me a little bit off guard because I didn't really catch it until the latter portion of the week when the sell-side activity grew and the volume, in fact, even grew inside of the bond market. You can also see the exact same thing inside of the 10-year, and what that is doing is taking interest rates considerably higher at this point in time. I mean, on the week we started, and again, if you look at this, it says 7. That's not 7%, people. You're talking about, 0.7%, but we actually shot up. Again, it's a considerable move in interest rates. This is the 10-year rate that you're looking at right now versus that's the TNX versus like TYX. And, okay, TYX, of course, would be the 30-year, which also exploded a bit higher. Along with that, and again, this is a real standout, the dollar saw some sell-side activity. Both of those products, and the reason I'm bringing it up is both the products, when the dollar is selling off, I just don't feel that there's a tremendous amount of risk in the world. Because if risk is going to just come piling into the marketplace, and what I'm talking about is if the S&Ps really started to get harsh and sell off, okay, I really believe that the world is actually going to run towards the dollar. The dollar's a lot safer than the euro. It's a lot safer than the, yuan. So I would actually look at this as, you talk about like risk on, risk off. But right now, I'm just not feeling a whole lot of risk in the S&Ps. The dollar is selling off. But then the same is also true, of course, for the bond market. So the bond market starts selling off a little bit. And that's a bit unusual as well, because again, there was a little bit of sell side activity in the marketplace, but you wouldn't know it by looking at the bonds. Okay, I mean, are traders kind of deleveraging a little bit here, coming into what could be a period of turmoil, some risk, possibly. This is going to be important. And again, there are times when I'll do these weekend updates, or just as a trader, I'm telling you right now, I'm just pointing this out because I have questions just like you. Why is this? What's going on in here? If you look at like the TLT and pull up like auto expected moves, all right, this is why I'm really bringing it up. And a lot of people maybe aren't necessarily familiar with expected move, but the bonds actually cracked way outside of their expected move. And that, people, is actually what caught my attention this week. It wasn't the fact that the bonds have been selling off a little bit. No, it's when they actually cracked lower outside the expected move and stayed out there. It's that was a little bit of a surprise. We'll see what occurs in the days to come on that particular front. So we'll move past it. Again, net, we have some earnings coming out, of course, this past week, and a ton of earnings that are coming this coming week. I mean, the monsters of tech are due up with earnings this week, so expect not necessarily wild market moves on that particular front, because today, you had Intel actually out last night, and today you didn't see much of an impact to the Nasdaq because of Intel. I know it's only a $200 billion company. Nevertheless, it didn't have much impact to the broader marketplace, and you're going to have some heavyweights starting to hit. Of course, the likes of like Apple. Pretty much, again, most of your monsters of tech are going to have earnings. The Nasdaq could be under a little bit of pressure throughout the course of the week, both higher and lower. But again, I expect a large mixed bag of goods, because that's exactly what we've seen in earnings. One good, one bad, one absolutely horrible, one absolutely spectacular, like Snapchat, which is now, it hurts me to say this, a $40 product. So again, I wanted to dedicate a very large portion of this weekend's update to what I kind of call decision time. Hedge, hold, or fold. So we're coming into the election, and I think the best way to kind of delineate this, of course, would to look over at the S&Ps. And the S&Ps are just a hop, skip, and a jump off the all-time high. In fact, in this case, I'm going to go over to the spiders. They're just a hop, skip, and a jump from the all-time high. But the closer that we start to come to the election, we start to look at things like implied volatility. And I've been looking at the implied volatility, the spiders, okay? And again, I actually, in this particular case, to look at implied volatility, okay, the spiders are a great way to assess, okay, risk. But I'm more comfortable looking at the SPX. And why? Because that's the SPX is really like the mother of all products. So when I say decision time, hedge, hold, or fold, what are you going to do with your own risk? Okay. And when I say, what are you going to do with your own risk? Like, literally, like, most people are just going to, whatever. I got a 401k. I'm in it for the long haul. Okay. But those of you that are traders and you do understand how to mitigate risk, when you start looking down, okay, at implied volatility, one of the interesting things, and again, I was talking about this in last weekend's update, you start to read into this and you will see, and again, the divergence right here is the divergence. Obviously, November 2nd, there is no election. November 4th, there is an election, between these dates, and the risk really starts to jump. But that isn't actually the key point. The key point in here is that most of that risk really starts to surface, and you find this I find it interesting anyway. It doesn't even surface so much out in January as look at the December volatility. That's the peak of it, people. Okay, is again, December volatility is at like 28.76. You get out all the way to January volatility, and it peaks out at like 29. You gotta I got a question on that one. Are they expecting the election to not be solved until this point in time, because then the volatility kind of drops off thereafter? So it is a bit of a concern, because if you're going to be hedging, that hedge may not be in the near term. Like, you may be in a period of turmoil for months, and that is what the marketplace is starting to dictate. But once again, I don't look at the risk in here as being alarming. We're sitting just under right now a 30 VIX. Okay, but the VIX is the 30-day volatility. right? But in this particular case, I'm not even that concerned with 30-day volatility. The irony is going a little further out in time, again, it peaks out somewhere around like the January expiration, and that is a little bit disconcerting. So when I say decision time, hedge, hold, or fold, I wanted to look at some of the key products, okay, that are really players in terms of risk. One of those being the VVIX, that's the volatility of the volatility index. And when I take a look at the VVIX, as I said, the volatility, it's the volatility of the volatility. It's like, how volatile is the VIX, okay? This is indicative of a lot of professionals that are coming in and they are, in fact, using the VIX options, okay, to mitigate risk. They are using VIX options. But the one thing I'm going to tell you about this, okay, only some of the sharpest arbitrageurs and volatility arbitrageurs pretty much in the world are actually hedging using the VIX. So although the VVIX can be a decent indication of looming risk, I do not think that it's a wonderful indication of who's hedging and who's not. For who's hedging and who's not, I would actually look at things like SPX and SKEW. Now let me cover SKEW first, because some people are kind of familiar with SKEW. Maybe some of you are not. But when you start looking at SKEW, first of all, it's dots on a screen. Dots on a screen are so exciting. But when you look at SKEW, and I'll actually come down here, I'm pretty sure I have a style built for SKEW. This is what I call SKEW line. This is a 10-year kind of daily on this. First and foremost, what is SKEW? Okay, and then more appropriately, why are we even bothering looking at it? All right, the way to actually explain SKEW, we're going to cruise over to the spiders. Okay, and on the spiders, to explain SKEW, we're going to go out just about 30 days, because that's what SKEW actually indicates, 30 days. We're going to pull up implied volatility in one of the columns, which is exactly what we have in there right now. So implied vol. What SKEW happens, okay, to be, all right, it's kind of a gauge, if you will, of the out of the money put implied volatility versus the out of the money call implied volatility. And that SKEW, okay, is kind of measuring the differentiation. Like, again, we're not huge out of the money here, but we're at the 275 puts that are about 30 days out. And in this case, they're trading for about a 40 volatility. And if you kind of go, well, we can call this like equidistant, but if you kind of go a little bit like equidistant out of the money, like how far out of the money are we here? Oh, listen, right now we're at close to like, 345. I'm looking all the way down at the 275 to make it easy, but just go to like the 300 strike. If you look at the 300 strike, that one's about 35%. So I'll go close to, and again, let me just scroll out over here. I'll go about $50 out of the money on the, again, on the call side of things. And as you scroll out, you come out here and it's about 18% implied volatility. So what SKEW is really looking at, it's looking at the differential of out of the money put premium versus out of the money call premium. And it's actually using this implied volatility to come up with a calculation, right? And when SKEW is high, all right, when that SKEW is high, it effectively means, okay, there is a huge demand for puts. Okay, there's this huge demand for puts, and that is often indicative also of huge hedging activity. And that is when everybody wants to buy puts, they go out and they buy puts, and then often they finance the cost of those puts by selling calls. And as you do that, by the way, the more puts you buy, obviously it raises demand. But when you're actually buying puts and financing with calls, you're actually creating on one side, on the put side of things, okay, if you think about this, the puts, you're creating demand. And on the calls, you're creating supply. And that would actually drive the SKEW higher, right? Because everybody demands puts. It actually puts the premiums up for there, but they're trying to sell calls to finance the puts. So it actually drives the premium down. But right now, frankly, we're like middle of the road. So the reason that I'm covering this and trying to dig a little bit deeper into it, we're actually even towards the lower end of the spectrum. So there's been this, this conversation in the entire marketplace, and everybody's hedged right now. Where's the risk? Is everybody really hedged if the SKEW is that low? Okay, I don't necessarily believe so. So I look at the VVIX. The VVIX is absolutely high, but the VVIX is indicative of like professional but more like volatility arbitrageurs, like, like mom and pop ain't going into the VIX and using it as a hedge, right? Okay. And these portfolio managers, right? They're not going to, like, when I say portfolio manager, the Carl Icahns of the world they're not telling their traders, like, load up on VIX calls. They don't even know what the hell that is, right? Most of them are just, they'll go out there and use different derivative products. But again, the VVIX, as I said, I don't think it's a great indication of overall hedging activity. SKEW is probably a better one. So I dug a little bit further, okay, and I'm actually going into the SPX here, again, the SPX, and I'm gonna go, when I say a little bit further, okay, further than anyone has ever gone before. Now, what you're actually looking at down below, and this is just one of the tools on thinkorswim, and it gets this kind of tool kind of gets lost in the crowd. Like, people constantly like forget about it, and I'll kind of blow it up to like a full screen here. They constantly kind of forget about this particular tool. What you're looking at, and I'll kind of explain it. All right, this is just open interest, and each one of these little boxes represents open interest. Now, everything right up here, this is the call open interest, and everything on this side of the screen is the put open interest. What I'm doing right now is I'm shopping around. I'm only looking at 200 strikes, and we're looking specifically in the SPX at 200 strikes. Again, looking at open interest, and I only have like 39 series. What does that mean? What 39 series means, okay, and I'm actually going to click this open. I picked just everything from right now, and it's okay, like right now. When I say right now, like, could I drop off the November 2nd and this and this and this and this? Sure, I could drop these off because they're before the election, okay? And then I could further drop off everything else in here. And again, I just wanted to show you, this is kind of a slick little tool when I say all series, okay? What I would suggest in here is just to highlight, and I'm going to do it with you right now, just highlight, all right, the open interest kind of between now and, as I said, all the way out to the January kind of monthly. I'll even incorporate some of the January weeklies just past that. So in this particular case, I'm picking 20 out of the 39 series. And then what I'm actually doing and looking at these boxes is I'm kind of shopping around. Is anybody making any wicked or wild bets on either side of this marketplace? I'm looking at the call open interest, which is right now 2.3 million. Okay. And that's, again, just in the series I selected. This call open interest in the SPX, and then the put open interest, which is 2.15. I just wanted you to see, okay, 2.15, 2.3. They're actually very, very similar in terms of like the open interest in there, right? And then I'll take this even a step further. I'll look at stuff like this. And when I say like this, just hover your mouse over it. Okay. There is 76,000 contracts that are open of the 3,000 strike. All right. And then, you can actually look at the call open interest here. Ironically, there's 60,000 also of the 3,000 strike. So is that really far out of the money? No, it's not necessarily all that crazy. So we're, 3,400 and change right now. This is not an unusual trade at all. Why? Because it's a 3,000 strike. It's probably just big numbers because it's at the biggest round number out there. I don't see any wicked outside bets on the puts. I do see a couple kind of wicked outside bets on the call side of things. Check this out. The December 4,000s. Okay. I mean, that's some pretty hefty open interest out there, but nothing is a definitive standout on this. And that's why I wanted to really kind of separate fact from fiction. There's so much garbage out there. Everybody's hedged. We're not going to do anything. If anything, okay, the SKEW in the marketplace right now kind of says that, no, they're not necessarily hedged. Looking at the open interest in the SPX also kind of furthers that. No, there's actually some big bets in calls as well as puts. So I'm taking you through this because I kind of want to open up your mind to the idea, okay? Are there any wild outside bets? Not really. And it's fairly even on both sides of the marketplace, okay? And I got to tell you, all of this to me kind of like adds up to, this thing is far more capable of making that like 50-50 kind of move. Like, you're looking at this, and again, everybody wants to read into, what are the option markets saying about risk? Are we going to go higher? Are we going to go lower? I heard the other day, everybody's hedged, so the only place we could go is up. And everything I just looked at completely disagrees with that. It does. I mean, look at some of the data. By the way, I spent time looking at the SPX. But before, of course, recording this, I also, of course, looked extensively at the SPY as well. Okay, there's some size trade inside of the spiders, and I dug into the spiders a little bit with product depth as well. And again, this is found like on a lot of different trading applications, but the spiders, like, I saw the exact same thing. Nothing too crazy inside of the spiders. And again, I wouldn't necessarily highlight all 37 series, right? Just come in here and start to highlight, like November. Maybe some of the December options, right? December quarterlies, maybe pop a couple of January options in there, and you'll start to see, again, the open interest is much closer than you would have expected, both in the spiders and in the SPX. And the SPX, a couple of million contracts out there. I mean, 2 million contracts in the SPX for 6 million in the spiders. 6 million in the spiders sounds like a lot. That's nothing. The SPX is 10 times the size of this. So this is like a little peon. That's why I say the SPX is the place to go. It's the mother of all products. Why am I taking you through this? Because I'm trying to prepare you, okay, for the fact this marketplace right now, nobody knows anything. All right. And you as a trader, okay, I'm telling you right now, you better know what your delta happens to be. It was a terrible delta. You better know what your delta happens to be. Right? Mitigate risk if need be. We're about to actually substantiate bigger moves than I believe, okay, that people interpret this to be. It's just, we're looking at this and we're looking at like a 30 volatility. Have respect for the fact that the SPX is saying, okay, almost a 30 vol. Why should I respect it? Because what that in the end kind of breaks down to, when you start to look at this on a, standard deviation, 30 vol, okay, 30% vol. Volatility is always annualized. So if you look at a marketplace right now, that's roughly 3,465. It literally says over the next year, we're poised to move up 30% or down 30%. And you go, okay, but that's over the next year. Yeah, I got it. But what does that mean between now and like the January expiration? Take a quick glance, okay? It's almost a 400-point move. It's almost a 400-point move. And the crazy part of that, that's only a 1 standard deviation move. And that's why I'm telling you, based on what I'm looking at in here, there's no real wild and woolly bets. The skew is actually relatively low, okay? You better be prepared and fully prepared for some substantial moves coming up. It doesn't necessarily pertain to the election. What I'm telling you, okay, is there's pent-up risk in this marketplace. Last but not least, the expected move. So, I went out and I did a video this Wednesday, and I said expect markets to actually drive lower and actually touch the lower edge of the expected move. If you look at this, you're like, oh, it didn't touch the edge. It actually, in fact, did. If you looked at the S&P futures, okay, S&P futures did actually drive considerably lower on Thursday evening before bouncing back up. Nevertheless, okay, same range next week. Very, very similar expected move. Once again, anticipate us hitting the upper end or lower edge of that expected move, as we have done almost week in and week out. I am still not going to be a huge premium seller at this point in time. I will spend much more time in just, again, we're only a few days out now from the election. As it comes to it, I'm going to be looking at this day in and day out. Is risk growing? Okay. Is there heavy open interest? Are there large bets coming in and open interest growing out there? We're going to be looking at all of that and more in this next week on TheoTrade. Thanks, everybody, for joining us here at TheoTrade, and have a wonderful weekend. Bye-bye.